Hello everybody and welcome back. This is Swati Gupta, Chartered Accountant. Today we are going to study International Accounting Standard 1, or you can say Indian Accounting Standard 1. The name of the standard is Presentation of Financial Statement. Both the standards can be studied together because there are no sort of much differences between them. There is one carve between them. We'll study it, we'll discuss it in the later part of the video. The whole video will be recorded in English language. From now onwards, there are both English and Hindi lectures available on all the standards. So in case of any language issue, you can definitely check out other playlists available on the same channel itself. So before we begin, if you are new to the channel, subscribe to the channel, and if you like the video, don't forget to like, share and comment on it. So without any further delay, let's begin. What does financial statement include? Financial statement includes balance sheet, P&L, cash flow statement, statement of change in equity and notes to account. These whole 5 statements all together are considered as complete set of financial statements. Okay, what it contains? Balance sheet, P&L, cash flow statement, statement of change in equity and notes to account. Next, types of financial statement. There are 2 types of financial statement. First, separate financial statement, that is individual entities financial statement, and consolidated, that is group financial statements. These have same form and content, okay, unless and until some specific changes are being asked for consolidation. Okay, they have same formats, they have same forms and nature. Now Ind AS 1 is only applicable on the final statements, okay, annual statements. It is not at all applicable on interim statements, interim financial statement. So if interim financial statement reporting is done for management purpose, it can be done if it is not adhered to Ind AS 1, okay. Now one more thing that comes is important definitions. So before we move ahead, in financial statement presentation standard prescribes some definitions that are used, that become basics of other standards as well. So whenever this name pops out, you have to remember that what it considers, what we have considered in the definition. Now first comes general purpose financial statement. Any statement that is intended to meet needs of general users is known as general purpose financial statement. No specific purpose, okay. Now Ind AS is prescribed as per section 133 of Companies Act 2013. So if you fail to observe, if you fail to follow Ind AS, okay, then you also fail to follow and comply section 133 of Companies Act. Thereby you fail to comply all the provisions of Companies Act 2013, okay. So if you fail to comply with Ind AS, it is a requirement in section 133 of Companies Act, you fail to comply with Companies Act as well, okay. Now if not complied with Ind AS means not complied with Companies Act. Now impracticable, whenever you see a word impracticable under any AS, okay, under any standard and under any Indian accounting standard, international or IFRS, what does impracticable means here? That after applying requirements, okay, after applying all sorts of measures, okay, any requirement is impracticable when the entity cannot apply it, even if after making every reasonable effort to do so, after trying their hardest, after trying all the means, they could not apply any sort of requirement, then it is known as impracticable. Then it is termed as impracticable in this Indian accounting standard, okay. So whenever you see a word impracticable, that means a situation where entity is unable to apply any requirement that was required by the standard. Okay, quickly revise. Firstly, general purpose statement that fulfills the need of general public. Ind AS is also required by section 133 of Companies Act. So if you fail to apply Ind AS, then you fail to comply with its section 133 of Companies Act as well. Now impracticable, after applying all the means, all the reasonable efforts, the company is unable to apply or require all the requirements of the standard. Now next comes as total comprehensive income, very important. Anybody and everybody are confused, okay, what is this TCI, total comprehensive income? Now total comprehensive income is, first of all, very important. It is the addition of PL, profit and loss account, plus other comprehensive income. Now P&L, we have incomes, expenses and the total is known as total of P&L. Now other comprehensive income has incomes, expenses, the total of is known as other comprehensive income. Now if we add this both, we get total comprehensive income. Okay, so in simple words, the total comprehensive income is income that has been earned out of the actions done, out of the transactions done that are done other than the capacity of owner. If any action and if any transaction done in owner's capacity, and if any income arises, if any change in equity arises, then this is not considered in TCI, total comprehensive income. Okay, now P&L has their own income and expenses and OCI has their own income and expenses. Okay, the OCI will contain income only and only if it is asked specifically by the standard. Otherwise, all the incomes will come in under P&L head. The other comprehensive income, that is OCI, have always been a problematic issue. Okay, everybody gets confused in OCI. So what, to simplify, there are 9 items. There are 9 items that are always considered under OCI. Okay, they are always considered under OCI. This is specifically asked by accounting standards themselves. Okay, that such transaction if occurs and if any gain or loss is there, then it will be transferred to other comprehensive income. Okay, now condition to recognize at OCI is that firstly, the income and expense that are not recognized in PL. First of all, the OCI item should not be recognized at all in PL. Otherwise, it will be doubled if it is considered in PL also and OCI also. Okay, so first condition is that the OCI item should never be considered in PL. Secondly, it should be specifically permitted by the standard. Okay, it should be specifically permitted by the standard to consider it as a OCI item. And these are 9 items that are being listed as per the standard. First, change in revaluation surplus. Second, remeasurement of defined benefit plan. Gain loss arising from translating financial statement of foreign operation. Gain loss arising from investment in equity instrument classified as fair value through OCI. Gain loss in financial asset classified as fair value through OCI. Effective portion of gain loss on cash flow hedge. Change in time value of options when separating from intrinsic value. Changes in value of forward element when separating from spot element. Financial liability when changes are recognized in OCI. These all are discussed in their respective standards. Okay, you don't have to worry and learn them right now. You just have to know that if any item is included in this list, then this will be considered as other comprehensive income. Otherwise, it will go into P&L. Okay, now total comprehensive income includes what? Income from P&L and income from OCI. Okay, other comprehensive income. And in total, in simple words, it includes all the transactions and their profits and losses done in the capacity, from the transactions which is done in capacity other than the owner. Okay, in usual, in casual, in regular running of the business, if it is earned, then it is TCI part, otherwise not. Next, features of general purpose financial statement. Very important, very important. Okay, it is true and fair only and only when the following conditions are met. First, an explicit and unreserved statement for compliance of Ind AS must be made. Explicit means separately, and unreserved means without any condition, without any ifs and buts. Okay, so for compliance of Ind AS, it will be considered true and fair only if separate. Okay, only if explicit, that is separate statement, and unreserved, that is without any ifs and buts, will be made, then only it will be known as fully true and fair. Second, inappropriate accounting policy cannot be rectified through notes. If any wrong policies are followed, okay, it cannot be rectified just by putting a notes to account. And thirdly, departure from Ind AS only when permitted by Ind AS. At times in different standards, it is permitted that if you are unable, okay, if it is impracticable, or in any case, you can take reference of some other standard. Okay, so departure from Ind AS is allowed only when the standard, the Ind AS itself allows such departure. Okay, if 3 of the conditions are satisfied, then only statement is known as true and fair wholly. Going concern means business entity shall continue in future without any break. There is neither intention nor necessity to materially curtail the operations of business. Going concern means it has future expectations that the business will go on running and keep nurturing, keep giving economic profits. Okay, it has no intention. There is no intention and not any sort of necessity to materially curtail, that is, materially stop the potentials of the operation. Accrual basis, record the expenses as and when it occurs, as and when the actual cash is received. We have to not wait for that, we have to see as and when it becomes due. Materiality and aggregation, very simple. Only material items shall be disclosed, immaterial items shall be aggregated. Okay, it shall be aggregated under one head like miscellaneous and all. Only the material items means any item that can influence the financial statement users decision making. Okay, then that is material. Other immaterial items should be aggregated, should be clubbed under one head and shown as miscellaneous and all. Next, offsetting. Offsetting means asset and liability set off. Okay, their net off is known as offsetting. So offsetting of income and expenses, assets and liability. As per the general rule, the Ind AS never asks to offset any of asset, liability, income or expenses. It asks to show it separately. But in case if any specific item is there and Ind AS has prescribed such offsetting, then only such offsetting can be done. Okay, for example, DT and DTL, both are never shown in the balance sheet, they are always netted off. Okay, frequency of reporting, once a year only. It has to be reported once a year. Comparative statement. See, minimum comparative information required is 2 balance sheet. That means you always draw balance sheet and you draw it 2 columnar, previous year and current year. This is 2 balance sheet, 2 columnar balance sheet, 2 columnar P&L, 2 columnar cash flow and 2 columnar change in equity and 1 notes to account. This is what all the comparative information that is needed by the Ind AS. Ind AS 1. Now, additional information is needed due to change in accounting policy retrospectively. Okay, if any accounting policy is changed and that has to be given effect retrospectively, then additional information is required. That is additional information in addition to this basic comparative statement. Okay, what are they? We have to give 3 columnar balance sheet, that is 31st March 2021, 31st March 2020. We always used to give current financial year, previous financial year, and then the start of the previous financial year. We have to list down 3 columns. First, the end of the current financial year, end of previous financial year, and then starting of previous financial year. Okay, we have to give 3 values, 3 columnar balance sheet in case of accounting policy changed retrospectively. Consistency must be consistent from one year to year. Any policy that has been adopted should not be changed frequently. Okay. Next, structure and content of balance sheet. What it is given? First, we have to always show assets. That too in this order. First, non-current asset, then current asset. After that, total of this. Now, equity, non-current liability and current liability. This should be in this order. Balance sheet should be represented in such order. Now, this total of A should be equal to total of B. Okay, this is simple overview of structure of balance sheet. First, there should be asset portion and then part B should be liabilities portion. Total of A should be matched with total of B. Next, current versus non-current. See, in assets and liabilities, we always see a standard rule: 12 months, more than 12 months, then non-current, and as per current, it should be less than 12 months. Okay, but your Ind AS prescribes their own rules for being calculated and considered as current. Okay, you have to fulfill these 4 conditions, otherwise not. Current asset, if any of the following condition is satisfied, then it is current asset. Condition is that either it is cash or cash equivalent, it is held for trading purpose, it will be realized within next 12 months from the balance sheet date, realized in operating cycle. Okay, operating cycle is, for example, of 1 year 6 months. Okay, then what happens if the amount is realized, if that asset is realized in 1 year 5 months, then it will be considered as current asset. Okay, now what are the conditions? Please revise. Cash or cash equivalent, held for trading, held for 12 months or less. Okay, will be realized in 12 months or less from the balance sheet date and will be realized in operating cycle. Any of these conditions are satisfied, then it will be current. Otherwise, other than current asset is always non-current. If any of all the 4 conditions are not satisfied, then it will be classified as non-current asset. Similarly, for liabilities, if any of the following condition is satisfied, then it will be considered as current liability. Held for trading, will be settled within 12 months from the balance sheet date, will be settled in normal operating cycle. Okay, this was same as asset. Now another fourth condition is that at balance sheet date, entity has no unconditional right to defer payment or liability beyond 12 months. Okay, it should have no deferment, no unconditional right to defer that payment. Okay, if it can defer that payment, it will be considered as non-current liability. If it has no conditions, no rights to defer that payment, then it will be considered as current liability. Okay, everything, if all the 4 conditions are not met, then what happens? It will be considered as non-current liability. Okay, non-current liability. These are 4 conditions. This need to be kept in mind. What is operating cycle? Operating cycle of an entity is the time between the acquisition of such asset and their realization in cash. Okay, for example, you acquired that asset on 1st August and you realized it in cash, for example, 2 months later. So such 2 months is known as operating cycle period. For simple calculation, it is known as inventory holding period plus debtor collection period. Okay, mathematically this is given in the standard itself. Inventory holding period plus debtor collection period. If operating cycle is not identifiable, then assume 12 months. If you have to solve any question, then or you have to apply it in practical and you are not able to realize the operating cycle, okay, you are not able to calculate the operating cycle and assure what the time period will be, then you can assume it 12 months and bifurcate that asset into current or non-current. Similarly, all the entities may have different operating cycles. Next comes a special treatment. In case of specific items, there is special treatments given under Ind AS 1. Okay. First, electricity deposit. Although refundable, the deposit is always refundable at any time, but in practice, business practice, such refund is not expected in near future. Therefore, electricity deposit is classified as non-current. Okay, electricity deposit is considered as non-current because we don't assume that we'll get the refund of it in next month only. We'll realize it, we'll encash it. We encash the electricity deposit in the last case when we are shutting down the business and all. Okay, so in general case, it is considered as non-current liability or asset. Sorry, non-current asset. Tender deposit, if it is recoverable within 12 months, then it is classified as current. If not recoverable within 12 months, then it is considered as non-current. Tender deposit is what? Any deposits that is done for tender. For example, there are 5 people and one wants to sell their scrap or give any sort of deal. Okay, they ask for tenders, they ask for quotes. Everybody give their quotes and whichever is feasible, the company elects that and deals with it, does a contract. So everybody has to keep a minimum amount of that deposit. That is known as tender deposit. Okay, if it is realizable within 12 months, then current, otherwise non-current. GST paid under dispute. If it is under dispute, if it will be settled within 12 months, if it is expected, then it is current, otherwise non-current. Next, treatment of loan liability. Okay, repayment due in next 12 months, then that portion will be considered as current liability. Repayment due after 12 months, then this will be classified as non-current liability. If loan is payable in installments, then installment due in 12 months will be current and the balance portion will be non-current. Okay, the whole loan if paid in one go, if it is due in next 12 months, then it will be considered as current, otherwise non-current. And if it is an installment, the installments which are due in next 12 months will be considered as current and the remaining balance portion will be categorized as non-current. Next, repayment of loan through bank transfer. If transfer from different bank, then the classification of old loan continues. Okay, if the last loan was non-current, then the non-current classification will continue. New loan shall be classified as per the new terms and conditions. Old loan will continue with the old terms and conditions, old categorization, and new loan will be continue with new terms and conditions. If transfer from the same bank, Then if agreement is finalized before the balance sheet date, then the classification of old loan shall be as per the new loan. Okay, if the deal, if the contract, if the agreement is finalized before the balance sheet date, then what will happen? Then the old loan classification will be done as per the new loans classification. Whereas if agreement not finalized before the balance sheet date, then the old loan classification will continue. Then the old loan classification will continue. If it was non-current, then the new loan, okay, then the same loan will be considered as new as non-current. Okay. If agreement is finalized, then as per new loan. If agreement is not finalized, then as per old loan. There is potential of refinance on balance sheet date. Okay, the agreement is not yet finalized. The potential. Okay, the only it is being discussed. Okay, the deal is being negotiated, but nothing is final on the balance sheet date. Then this is because of potential of refinance and not relevant, and old loan classification will continue. Okay. Next comes the carve. This is a carve. What is it? Breach of long-term arrangement. In case of breach of long-term arrangement, that means any condition was given and you satisfied it and you got the loan. And in further condition, before payment of the loan, during the loan period, okay, you breached any condition, you dissatisfied any of the following condition which was very much required, then this is known as breach of loan agreement, long-term arrangement. Then as per Ind AS 1, okay, non-current loan liability, if any material provision of the loan is breached at the balance sheet date, then such loan liability shall be classified as current. Okay, here also it is same. If non-current liability, any material provision is breached, then at the balance sheet date it will be classified as current liability. Okay, it is same. But as per Ind AS 1, on rectification, if the rectification is done after balance sheet date but before the approval of financial statement, then not to demand such payment as a consequence of breach, and it will be reclassified again as non-current liability, whereas this option is not available as per International Accounting Standard. Okay, this is a carve in, that means it is an additional point as in Ind AS, okay, and it is not in International Accounting Standard. That's all for this video. I hope it is very clear to you. In case if you need the PDF notes of this video lecture, then you can check it out in the description box. You can download it and keep it for your reference. See you in the next videos. Till then, take care, be safe, stay tuned.